AM 580, always streaming inside your very own WDBO app. I got two certified financial planners from the Certified Financial Group here wrapping up a year, I can say. It is the last episode of 2025 here this December 27th, last episode of a wonderful year, of a kind of an uncertain year, but also a certain year. I'll let the experts here dive into a year if we like, but it has been a year that it has been. We have Wynn Smith and Joe Bert, two certified financial planners with the Certified Financial Group, here getting us through this hour of On the Money, as they have done so for nearly 4 decades on the airwaves. Award-winning certified financial planners at your ear tips here on the air at WDBO. Joe, Wynn, how we doing today?
We're doing great. I hope your holiday Christmas season was good. You and your family, everything good, I hope?
It was wonderful. We were traveling around.
Hardly the year's coming to a close here, but we're delighted that we're here and you're here and our listeners are here. As you said, Wynn and I and the staff here at Certified Financial Group has been doing this now for almost 40 years. Hard to believe, but we're here to take our listeners' questions, as we have for that time frame, things that might be on your mind, things you're thinking about, long-term health care, annuities, reverse mortgages, insurance, stocks, bonds, real estate, IRAs, 401ks, all the things that Wynn and I and the 15 other certified financial planners deal with day in and day out, providing retirement planning, investment management for a fee on Monday through Friday. But as we like to say, on Saturdays, we're here for you absolutely free. So if there's anything on your minds, just let us know, and we're going to take it away. Topic for today, Wynn, is
important financial numbers. So, Joe, here we are kind of wrapping up 2025, maybe looking ahead at 2026. And there's certain numbers, financial numbers. Well, there's certain numbers that are important anyway, but financial numbers, there's certain ones that if we key in on those and we kind of focus on those, since the numbers don't lie, they're a good indication as to where we are and where we're going. So the first one that you hear talked about a lot is your net worth. And net worth is important because that is kind of where you are. And the other one is cash flow, so income and expenses. So when we look at our net worth, most people don't realize what their net worth is unless maybe they've applied for a mortgage or maybe done some type of loan or something like that. But your net worth is really your scorecard. That's really to let you know how you're doing, especially when you're in the wealth accumulation phase. And your net worth is basically everything that you own minus everybody that you owe, and the difference in those two numbers.
It's, as we say, it's the bottom line.
It is the bottom line.
It is, in fact, the bottom line, and it's what your wealth is measured on.
That's exactly right. And there's also, you can also look into the quality of your net worth. So what I mean by quality, if you look at the things that you own, how hard or how easy is it to establish a value for those things? So some things real easy. You get a statement that has your value, or you can go online and you can look at something like the value of your home through Zillow. But some things are a lot more nuanced, like you have to get an appraisal, or you may get an opinion. And those types of things that we own aren't as high quality, not as valuable, but it's a little bit harder to establish those, so the value is not as high quality as something where we're getting a statement or something where it's easily established.
Or those collector coins you've had for years and you wonder what they're worth. Are they really worth what I paid for them?
Exactly.
Yep.
So it gets into that arena. And then on the other side is who you owe, so your debts. And again, there's a quality component to that. And there's a quality component of that is like, what interest rate are you paying on those debts? And what did you use that debt for? Did you use it for a good time, or did you use it to purchase something that's going to be increasing in value? So you're actually using leverage. That's the difference between smart debt and not so smart debt.
Right.
And as we see a lot of people with credit card debt, and you start kind of looking into where did that credit card debt come from, and they really don't have a good answer. Well, that's kind of a red flag in terms of money management.
Yeah, no question. And then you got short-term debt and long-term debt, and
that's right.
And you've got to balance those because they all have payment dates.
Right.
Even though it might be long-term debt like your mortgage, you still have a monthly payment.
Right.
Yep.
And then on the other side of this is our cash flow. So our cash flow is comprised of our income and our expenses. And you hear the term like somebody who's like I'm wealthy on paper. Mm-hmm. That's someone who has a lot of assets, but they don't have good cash flow.
Not much cash flow.
And then you've got other people, I'm sure you've seen people with tremendous incomes, or even think about how often we hear about professional athletes or entertainers who make millions and millions of dollars a year, and then, they're homeless or they're some menial job, doing something because they have no money.
They didn't convert that cash flow into assets which go on your balance sheet
Exactly.
to increase your net worth.
Exactly. And vice versa when you're in that decumulation phase, when you're taking your net worth and you're living off that money for the rest of your life.
Yeah. So the key is, to have enough income so you can pay the expenses. And there's a saying there that if your outflow exceeds your inflow, the outcome could be your downfall.
That's good.
How about that?
Yeah, I haven't heard
The
that.
outflow, if the outgo exceeds your income, the outcome is your downfall. Yeah. So you got to have positive cash flow, and hopefully that, and then what you have that positive cash flow, as we've said time and time again. What do you do with it?
Yeah, and there's some rules of thumb as to kind of where you should be based upon your income and your net worth. I mean, there's kind of some general guidelines, that varies per people, but based upon some research that was done, if you take your income and you multiply it by your age and you divide it by 10, that's kind of where your net worth should be if you want to be able to maintain your current lifestyle in the future.
So once again, take your income,
Multiply it by your age.
By your age, okay,
And divide by 10.
and divide by 10.
So if you got a 35-year-old who's making $100,000 a year, they should have a net worth of around $350,000.
Okay, there you go.
But so that should be equity in your home. That would be your retirement accounts, money in the bank. You do have personal goods, furniture, clothing, cars, things. They are decreasing in value, but they still add to your net worth, and they are counted towards your net worth.
Well, I'm not sure you want to put your clothes in there
Well,
on your financial statement, and even your car, because it's a depreciating asset. I guess you could put it there, particularly if you have an offsetting liability. You
Right.
probably do need to put the car there. Yeah.
yeah, sometimes I include it in financial planning,
Sure.
just for the psychological benefit of you're not looking good. But one of the things I do like with cars and even your personal articles is, how you can put an appreciation rate in there?
Right.
I'll put a negative number in there so that you can see that they're losing value 10, 15, 20% a year.
As time goes on. Yes.
Exactly, because they're wearing out.
Yeah, for sure.
So you need that's the first step in any type of planning or anything you want to do. Going forward or reflecting on the previous year is to figure out what am I worth? What if I had to cash out everything today? What is that number? And then the other part is getting a handle on the money that's flowing through your hands, the money that's coming in and the money's going out. And it's amazing how many folks I have met with over my career who just did not have a good handle on that.
Yep.
I mean, I can count probably on one hand.
Now, when we do planning, we ask our clients to give us the living expenses, and many times they're surprised at where all the money is going.
Or they just don't know.
Well, until you've taken the time to fill out that form and done some calculations, you really don't know.
Right.
I mean, if you're just winging it, so to speak,
Right.
that's one of the worst things you can do.
Right. So so figuring out where you are, and then figuring out where the money's going, where the money's coming from, where the money's going. I mean, those are just the two of the basic foundations of financial planning. And it's something everyone can do. You don't have to be working with a CFP to be doing that. I mean, there's a lot of apps now that track your help you formulate a budget. They track your income, your expenses. There's a lot of things out there that you can use to just get a handle on your financial situation.
Well, as you know, with our financial planning software, we set this up for our clients. We put all that information in there, and then we let them take it home electronically. So you can pull it up at any time. And then if you want to, you have the ability then to hook up your outside accounts, both your assets and your liabilities, to have a dynamic financial statement.
Yes.
And you could have it, 24/7.
That's right, real time.
In real time. So as things change in your life, for better or for worse, that financial statement is always updated, and you can always see where you are and how it's tracking, and if you're really on plan. So that's what financial planning is all about, as we've done for our clients for many, many years. But the nice thing is today with technology, the marvelous things we could do in terms of planning. And it isn't, we don't give you a plan, you walk out the door, and the minute you walk out the door, it's stale. But the beauty of the software we have now is it's dynamic, and it changes as your situation changes. So it's not like we give you a plan and, you kind of hope it works. That's what we used to do back in the old days. But now with the technology, we have the ability to have a dynamic plan that you take with it. You can have it on your phone. You can have it in your computer. And you can measure your success as the year and the years go on.
And the nice thing about that is the longer you work the plan, the more valuable the plan becomes.
Exactly. Yep. Yeah. Work the plan. That's the idea. Work the plan.
Because you're gathering, you're retaining all that historical data, so you can start looking at trends and things like that are going on.
Yeah. Life is, or managing your financial life is like running a little business.
Oh, absolutely.
And you've got to keep track of that income. Got to keep track of the expenses. And like any business, you have to have money set aside for that rainy day for when stuff happens. But that's what we do as certified financial planners, what Wynn and I and the 15 other certified financial planners have done now for going on 50 years. Like I said, though, back in the day, it was a calculator and one of those green accounting sheets that we used to do planning on. But today with technology, we can do some marvelous things. So if you want any more information about what Wynn and I do and the 15 other certified financials do for our clients, I encourage you to go to our website. That's financialgroup.com. financialgroup.com, and you can get all the information about Wynn and me. You can also look at the upcoming workshops that we have. We've got a workshop coming up here next month. Right, Wynn, you got the details on that there?
I do. Our next one that's coming up is on January the 10th from 10 to 11:30 a.m., and that's Charles Curry's going to be hosting that, and it's going to be Social Security planning, basic rules, and claiming strategies.
That's a Saturday morning. If you get here early, you can look at the monkeys here doing the radio show behind the glass, and we'd be glad to see you there. So that's January the 10th, you say?
January the 10th.
It's Social Security planning strategies?
Uh-huh.
All right. So once again, go to our website. That's financialgroup.com, financialgroup.com. Click on the link right there, and you can make a reservation. People say, why do you do this, Joe? We do it for basically two reasons. Number one, to hopefully prevent you from becoming a financial casualty, and secondly, to introduce you what Wynn and I and our 15 other certified financial planners do for our clients. In this way, that whether you need retirement planning or investment management now or sometime in the future, you'll give us an opportunity to earn your business. I hear the bumper music. Josh, take it away.
Thank you so much, Joe and Wynn. If you want to join the conversation, you can open up that WDBO app and send in your open mic for playback here on a future episode of On the Money. Thank you so much. You're listening to On the Money, where we're helping you plan tomorrow
Today.
with the Certified Financial Group. Hello and welcome back to On the Money right here on WDBO AM 580, always streaming inside your very own WDBO app. This is the first episode of On the Money after Christmas, but also the last episode of On the Money for 2025. So if you have any questions to maybe get you us all set for next year and you want to send them in, go ahead and send in an open mic using that free WDBO app. We have Joe Bert today sitting with Wynn Smith with the Certified Financial Group. And gentlemen, if it's okay with you guys, what do you say we head into the text questions to answer some of our listeners' questions?
Let's do it.
All right. This one is right on topic because it is Christmas just a few days ago. And Tammy says, guys, I overspent on Christmas this year again. What should I do when those credit card bills come in and they're due in January?
Well, this is not an uncommon situation, unfortunately. We become addicted to plastic, particularly the young people trying to keep up with their peers,
With their Joneses.
With the Joneses and the Smiths and everybody else, yeah. So what do you suggest, Wynn?
Well, a couple of things. One is, Tammy, the good news is that you're not alone. A lot of people do this, and a lot of credit card companies know this. So a lot of times the first of the year is when you start getting those zero transfer balance offers. So you may want to start taking a look at some of those, depending on your credit, and that would be a good indication how good your credit is based upon how many of those offers you get. But that would be one thing, because you obviously are going to have to pay off that debt, and you want to minimize the cost of that debt. So if you could find something that's a zero balance for a year to give you the opportunity to get rid of that debt without incurring any finance charges, that would be good. The other thing I would look at would be just take a look, like we were talking earlier about your cash flow. Take a look at your expenses and your budget and see, can you throw some additional money toward those credit cards?
That's the real key, to discipline yourself to do that, because if you don't, you're going to be going into next Christmas with that overhang of what you spent this Christmas, and all you're doing is compounding a problem. So you really want to look at that and force yourself to get that out of the way, because you don't want this. Credit will ruin your life if you don't take charge of it.
And Tammy, I noticed you said again, so apparently this is something that it happens every year. One of the things I would also look at, you don't see these so much anymore, Joe. You remember Christmas accounts?
Oh, yeah.
The community banks and mostly credit unions, you could open up a Christmas account and you could put in, a little bit of money every week or month, and then, at the end of the year, you'd have some money there, and there's your Christmas money.
You know why they don't do that anymore?
I don't see those so much anymore. I'm sure they're still out there.
I'm not even sure because people don't use cash anymore.
Well, that's true.
Everything's plastic. All the transactions and. Yeah, but I agree with you. I remember those some days past. But.
Yeah, but creating a budget, putting money away every month for your, you're going to be spending money at Christmas, so you kind of know how much you're going to want to spend. So you divide that by whatever, pay period, monthly, whatever, and start setting that money aside. Get ahead of it.
That Christmas account sounds a lot like something that my wife has. My wife works for Orange County Public Schools, and so she doesn't get paid for the summer break. And so one of the options they have is you can just set aside. Rather than dividing your annual check by 10, you divide it by 12, and they put some money aside every couple of paychecks for you. So you still get that income throughout the summer break.
No, that's a great idea. Yeah, I've heard that. I've heard of that. I've seen that, as a matter of fact. Yep.
That sounds like the Christmas account as well. December is the same time every year, so you can get ready for it when it comes.
Well, and Josh, that's a good point. When you look at, there's going to be birthdays, anniversaries, holidays, things are going to be coming up where you're going to want to give some gifts. That is an expense that you should plan for, and you should try to have a plan in place to cover that expense.
Yep. And when we do financial planning, we look at what's your gift allocation, and then figure out how that fits in the budget. And if it's in there and it doesn't mess things up, you know that you have that much money to spend throughout the year on those certain anniversaries.
And Tammy, the only other thing I would offer to you would be, maybe there's some non-monetary gifts that you could start looking at. There might be things that you can create or do that aren't as expensive as a shopping for a gift, that would just have as much value to the person getting the gift, but not be so hard on your budget.
And sometimes that's more valuable.
Yeah.
Yep.
Sure.
So I hear the bumper music there, Josh.
Of course, yep. If you want to join the conversation, we got some open mics available for you inside the WDBO app. Just go ahead and open up that app, hit the open mic button down in the bottom right-hand corner, and send in your question for the Certified Financial Group. You're listening to On the Money, where we're planning tomorrow.
Today.
With that Certified. To On the Money here on WDBO AM 580, always streaming inside your very own WDBO app. If you want to join the conversation today, I invite you to open up that WDBO app, find the open mic section, and go ahead and send in your question for these financial experts with the Certified Financial Group. Today we have Wynn Smith and Joe Bert, two certified financial planners with the very same Certified Financial Group. And the topic of today's show is important financial numbers. And I think we're going to be able to get back to that topic now because Tammy had such a great question in that first segment that we got a little sidetracked, giving her some great info.
Yeah, we in the start of the program, we talked about some financial numbers so we had your balance sheet, your net worth statement,
and cash flow.
And cash flow, which is your P&L, basically.
Exactly. And the third most important number, which piggybacks well on that last text question that we got, is your credit score. That's a number that you have to be aware of, and you have to manage that, just like you're managing your net worth and your cash flow. And even though, Joe, a lot of people, like, once they become, financially independent or they're in that distribution phase, they say, well, why do I need to worry about my credit score? I'm not going to be borrowing any money. I have plenty of money. But what a lot of people don't realize is that credit score is pervasive through all aspects of your life, like what insurance rates you pay. And you just never know. So staying on top of that number and managing that number so that it's going up, or at least not decreasing, is a smart financial move.
Yeah, so getting back to Tammy and the credit cards that she has, that may impact your credit score. And your credit score, as you said, impacts your insurance costs on your home, on your car, and
your ability to open a bank account. A lot of times they'll do that.
Often today, apartment
rent.
Your rent, apartment owners and landlords are looking at credit scores, determine whether or not you're credit worthy. So your credit score is really one of the most important things that you want to manage. And you can mess it up by having too much credit or having a bad credit history. The number one thing that impacts your credit score is timely payments.
That's right.
So if you miss a payment, you get dinged. And boy, that's one of the last things you want to do, because once you get in that trap, you really create yourself some problems. So focus on being sure that you're making those payments. Even if you're making minimum payments, be sure you don't miss a payment.
Right. Yeah, because it takes time, because it's the time, it's the history is what it weights a lot of that too.
Exactly. So it's credit score. What else you got?
And then the last important number, financial important number, is your tax rate or your tax bracket or your marginal tax rate, because as you well know, our biggest expense over our lifetime is taxes.
Right.
And knowing where you are and knowing what your marginal tax rate, so what that additional dollar is going to cost you in taxes, and then knowing your overall tax rate, because it is a composite of the different brackets that you're in. And just being aware of that, because that's very important.
So you use a term that, let's be sure we
Yes.
tell our clients or our listeners what a marginal tax rate is. What does that mean?
Okay, so there are different tax brackets, and the brackets are based upon your income.
Mm-hmm.
And as you make more money, you move up into more and more brackets.
Right.
So your marginal would be the highest bracket that you're in.
Right.
And then your overall tax rate would be a composition of all the brackets that you're in.
Right.
So the bottom bracket, I think, is 10%, and then it goes 12, and then 22, 24,
32, 35, and 37.
and then 37. So, if you're in the 22, you're not paying 22% on all your money. You're paying 10% on the first sum amount, and then 12% on the next sum amount, and then you're paying 22 on the additional amount.
Right. So, you have your marginal tax rate and your effective tax rate.
Yeah, effective. That's a better word.
Two distinct numbers. But you do need to understand what your marginal tax rate is, because that extra dollars that you earn is going to be taxed at that highest rate. Mm-hmm. And that's what you need to know.
And it becomes very important in planning. Like a lot of our clients, we work with them to do Roth conversions.
Yes.
So and a lot of people they fill up that marginal tax bracket with Roth conversions, because they don't want to be bumped up into the next highest marginal tax rate, but they do want to take advantage of maybe converting some pre-tax dollars into after-tax dollars.
Yes. So that's good. I'm glad you brought up that point, because doing those Roth conversions, if you're not careful, you end up creating yourself some problems by pushing yourself up in a higher tax bracket and really penalizing yourself unnecessarily. So you want to fill up those lower brackets, the 10 and 12% bracket. Stay away from trying to get in the 22, because it's really, really difficult to have an effective, good Roth conversion plan if you're doing that 22% tax bracket or beyond.
Yeah, you got to have a lot of time on your side for those monies to grow.
Right.
Yep.
And the key about doing the Roth conversions is you need to pay the tax with other money other than the money that's coming out of the account.
Good point.
So if you're doing a $50,000 Roth conversion from your IRA to a Roth, you want to have the entire $50,000 go into the Roth and pay the taxes from your outside money. Mm-hmm. You got to have that entire amount in the Roth to make the numbers work long term. So.
And one other point: if you're on Medicare, you got to be conscious of those Medicare brackets, premium brackets too.
Because IRMA will come back and bite you if you're not too careful. Okay. Anything else you want to cover on the numbers?
Those are the top ones there,
okay.
Joe. Just your net worth, your cash flow, your credit score, and your tax bracket.
10-4. All right, we've got a text question there. I see. Josh, take it away.
Of course, this one comes to us from Bill in Longwood. I love Bill is not mincing any words, except one of his words may be a typo, so I'll let you guys maybe fix that, or maybe I just don't know what a dinner annuity is. He says, all my retirement money is stuck in one of those fancy dinner annuities.
Oh.
And I can't move it because of the darn surrender charges. Do you have any suggestions?
Yeah, the dinner annuity is one that you bought after you went to the fancy dinner. That's what that is.
Oh, okay.
Yeah. We see that with some frequency with clients come in and they had this great meal, and now they have heartburn because they realize that what they bought isn't what they've been sold.
Wow.
Yeah, and it's really a travesty. A lot of folks out there, because the commissions are really great on those annuities, and that's how they pay for the meals. So you really want to, or not only an annuity but also life insurance. So anytime you have an insurance product being talked about as the end all be all at one of these seminars, it's really, you got to be very, very, very careful.
Yeah, and a couple of points, Joe. I mean, annuities products aren't bad in and of themselves, right? It's just the wrong application of a product.
Exactly.
And I think what this question was like all my retirement money. Well, that's kind of a red flag when all your money's in one thing.
Right.
So that's the first red flag.
Right.
Yeah, Joe, I agree with you. I don't know. I get these postcards, and I guess if you're not getting these postcards, you may want to look at moving to a different zip code. But that's a good indication that you're in a more affluent zip code, which is that's good. But these things are the draw there is to sit down for a nice meal and listen to a presentation, and it's not necessarily what's in your best financial interest. Mm-hmm. So you're being sold something.
Yeah.
And then the other thing was, you mentioned the surrender charges, and these products do have surrender charges. So it's very important that if you go into one of these products, you know that you're going to be in there for a while, because you don't want to have to deal with these surrender charges.
Right.
And that's just the structure of the product. It's not good or bad. It's just the way it is, because, Joe, as you mentioned, they pay commissions. These are commissionable products typically, and that's paid up front. So the insurance company has to have the time to earn back that money. So that's just the way they're structured.
Yeah, the big red flags in those annuities is the bonus. You put in, you're going to get a 10% extra when you put it in, or this. I've seen these time and time again. That's a real red flag, because there's no free lunch.
Yeah, where's the money coming from?
Or free dinner. Or free dinner.
Yeah.
The key is that and then they're going to talk about you're going to get show you this 6-8% return on your money. It's not a return on your money. Most of it is a return of your money, mm-hmm. because you've got to tie up your money for so many years, and they're giving you your money back with a little bit of return, mm-hmm. and they're showing it as a 6 or 8% rate of return. You got to be very, very careful with that stuff. So,
I did have a case recently, Joe, where it was a similar situation where there were an annuity inside an IRA, mm-hmm. and of course you can't roll it over because of the surrender charges. But a lot of these products will allow you to take 10% mm-hmm. without penalty.
Yep.
And so we took a 10% distribution, did an indirect rollover into the existing IRA. Now the trick is, like you mentioned earlier, you got to have the money to pay the taxes, or if they're being withheld. And typically these products do require withholding, mm-hmm. so you got to have the full amount going into your existing IRA, and you've got to do it within 60 days. But that is a way to get some of that money out of these products.
Yep. You're for sure. All right. I've got another text question there, Josh. Take it away.
You sure do. This one is going to be not too much contribution from me, because Lenny is short and sweet. Lenny wants to know, is now a good time to get out of the market?
Lenny is
I can guarantee that's the first question anyone's ever asked you that question, right?
Lenny is a closet market timer, and the time to be in the market is when you have some money for long-term investing. There's a difference between investing and speculating. By the nature of Lenny's question, is that he's really a speculator, trying to time the market, trying to figure out this is good time to buy, good time to sell. Our philosophy has been and continues to be diversified with quality. Markets will go up and down, but if you have diversification with quality and don't take unnecessary risks, understanding what your time horizon is, in fact, you'll be a successful investor. But investing is never a smooth, straight line. I like to say that if investing and dieting was easy, we'd all be skinny and rich. But you got to accept the ups and downs. You want anything to add to that, Wynn?
Well, I don't think there's a good time at all to be out of the market. I think you should have something in the market. I mean, even our most conservative investment portfolios have some market exposure, because that's typically your best inflation hedge.
Yes, to have some growth. So, you want to avoid trying to determine this is a good time to be in or out of the market. If you're getting your financial advice from the CNBC or from Fox Business or whoever it might be, people on the radio, you got to be careful, because you don't want to time the market. As we say time and time again, it's time in the market, not timing in the market, that will make you a successful investor in the long term. So,
and you've got to realize some of these other sources where they talk about market timing, their goal is to get you to pay attention or to listen or to read, whatever it is that the advice they're giving you. It's not necessarily what's appropriate for you.
Yeah, that's a great way to sell newsletters.
Yes.
I mean, back in the day, there were more newsletters sold for hundreds of dollars a year that always had the secret formula as to how you do it. There is no secret formula, folks. What you want is quality with diversification. Know what your time horizon is. Know what your risk tolerance is. And in the long run, it does, in fact, work. And you want to take more risk than you need to. But that's what planning is all about. You need to know how aggressive or how conservative you can invest your money and still have a high probability of not running out of money when you're 95 years old. Mm-hmm. And you could be wrong on both ends. You could be too conservative and not realize it and sit and look back and say, geez, I wish I'd have known this 10 years ago, because the well's running dry. Or you can be too aggressive and you're taking unnecessary risks when ratcheting it down a little bit. You'll get there without any problem. So, frankly, that's what Wynn and I and the 15 other certified financial planners do day in and day out for our clients, providing retirement planning and investment management for a fee. If you want more information about how we do that, I encourage you to go to our website. That's financialgroup.com. Financialgroup.com. We offer a no-obligation visit. Come by our office, learn about what we do, see if we can help you, and we'll take it from there. That's the way we do it. Anything else you want to add to that?
No, it's just there is that fear-greed cycle that we're all subject to as humans, that emotion. And I think you see a lot of people. I mean, if I had a client come to me and wanted to get out of the market of something, I think I would dig a little deeper to see what was really bothering them, because I don't think it's the market.
Yeah. And we are all, unfortunately, are emotional beings, and we make many of our decisions based on emotion. And our job as financial advisors is to try to wring the emotion out of the decisions need to be made. Let us make the decisions. Let us fly the plane. Sit back, enjoy the cocktail and the movie, and we'll get you to your destinations. I hear the bumper music. Josh, take it away.
Thank you so much. That's why it's always good to have a certified financial planner with the Certified Financial Group on speed dial, because there's just so much information to remember, and they have your back. Again, thank you so much for listening to On the Money. One more segment coming up. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group. Welcome back to our final segment of the year for On the Money here on WDBO. I want to thank the team at Certified Financial Group for continuing to give us great advice here on WDBO, as they have done for nearly 40 years on WDBO, an award-winning company to work with. So just the community loves them, the nation loves them, CNBC loves them, as they just seem to be in all the record books now, all the awards. Again, you got the On the Money show brought to you by the Certified Financial Group. We have Joe Bert and Wynn Smith answering our questions today. Joe, Wynn, what do you say we head back to the text questions?
Let's do it.
All right. Here we have, let's do Laura in Maitland. And Laura says, guys, should I buy or lease my new car?
Yeah, it's a good question.
That is a good question.
It depends.
Yeah, it depends. That's what I was thinking. There's so many different ways to look at this. I mean, one thing is, like, how long do you own your cars? Do you ride them and drive them into the ground? Do you trade more frequently?
I think that's the first point.
Yeah.
How long do you keep your cars? If you're one of the folks that drive a car for 8-10 years, you ought to buy, right?
I agree.
And of course, that begs the point. You got to maintain it and so forth.
Right. Yeah, I mean, there are these rules of thumbs. I mean, one thing is, you never buy a depreciating asset. You always lease it. That works out real well with computer equipment and things like that. Even vehicles, you see a lot of businesses do that. The other thing is, if the cheapest transportation expense to have, the cheapest way to own an automobile is to pay cash, buy it, and then drive it till the wheels fall off, and just until you run it into the ground, until it doesn't make sense to maintain it any longer. And that gets you, when you look at your car, you look at your cost per mile. And then also, if you're going to buy a car, a good time to buy a car is toward the end of the year, because a lot of times dealers there are looking to make their year-end numbers, and they're a little bit more willing to deal and do those type of things. So it is a good time to be looking for cars, but depending on whether you're going to lease or whether you're going to buy is really kind of depends more on your personal financial situation and your personal preferences, I think. I don't think there is like a general rule of thumb anymore.
Right. And what you want to do, if you're going to buy a car, maybe get your financing lined up with your credit union beforehand. So you can go in, you got it all done, and you can do the deal right there. Of course, the dealers make money on the financing as well, and they want to put you in their financial program. But look at the numbers and be careful in that regard. But should you buy or lease? I think it depends on a personal situation. Like you said, if you're going to keep the car a long time, you're probably better off buying it and maintaining it.
And the other thing too, Joe, is kind of a compromise would be not buy a brand new car. You look at a 2 or 3 year old car that's coming off a lease that has been maintained,
without question.
And the bulk of the depreciation comes when you first drive it off the lot. So those first years is where you get the bulk of that.
Yep.
And so, I mean, that's the other thing too, is you can be kind of smart about what you're buying.
You pay a lot for that new car smell.
Yes, you do.
And it disappears. All right, one more text question there, Josh. You got one more?
We got about 90 seconds left of the year, so let's go ahead and wrap this up with a very important question. Tom wants to know, what is more important, employment or inflation?
Sounds like he's been listening to all the talk about the Federal Reserve and what they're trying to do and interest rates and all that.
Yeah.
Well, I mean, that's what I'm assuming, Tom. I hope, if you're listening, where that's coming from, right? Because that is the Fed's. That's the Fed's. Their mission is to kind of balance full employment with low inflation, and they've kind of come out with inflation numbers and employment numbers. I would think that probably inflation is more important than employment because inflation affects everybody. Employment only affects the people without a job.
I would say that's true. But not by a lot, though, because they're very sensitive to the labor market.
That's true.
Yep, it's a two-edged sword that they got to balance. I hear the bumper music. Josh, take it away.
Thank you so much. We got some great workshops. For more information, go ahead and head to the website, or you can always leave an open mic inside the WDBO app. To get a hold of the Certified Financial Group, we can forward along any information we receive on our end. Thank you so much for a great year of On the Money, where we're planning tomorrow
Today
with the Certified Financial Group. And stay tuned for next week, next year, for a continuation. We got more coming up here.